All right. Good morning, everybody. So we had disappointing European data, and then NVIDIA had earnings too, which somebody says that it was leaked early, but we can't do anything about that. We have data today in the red, so 9:45 is going to be a really big deal, and then 10 o'clock with home sales tonight. Japan has the opportunity to influence the globe, so we'll see what comes out of Japan. The last thing for today to worry about is the 1 o'clock auction with that 20-year bond. That's going to be a really big deal, but after that, it should be good to go into the end of the day. So they're kind of coming at us from different directions today. It's not going to be a clean narrative. Going to be a pretty tricky thing, and we got Jackson Hole all day. I think the big one though for Jackson Hole is PAL. So the other events really aren't anticipated to be that bad. All right, so looking at what's going on the week, we took a rejection on that 50% level. So if we measure last week's entire candle, 44.33 is the 50% line in the sand. And you can see how we came up into that level yesterday and we took the rejection and pulled back away from it. Now we're still up on the week, but that doesn't bode really well for how the rest of the week is going to go, and certainly not how we wanted to really dig into this quarter. We're still considering the 20 MA bounce on the weekly as having happened. So the fact that we didn't really connect with it doesn't really matter. We still consider this a bounce that did happen, and we're working our way up. The fact that we rejected on that 50, since the week isn't over yet, that weekly candle isn't closed yet, and that rejection doesn't count yet. That's the way it works. If you're going to use a candle pattern, the pattern isn't valid until the candle closes. It still doesn't sit well, right, as a good way to say it. And if you think about the rejection that we did see yesterday, I'm going to just zoom in here because it'll remove a lot of the other stuff that's going on. This peak yesterday is that rejection on the chart. So it was the weekly 50% level. It was the weekly expected move level. It was also the 10-day moving average. So there was a lot of things there, right? With multiple levels of confluence of resistance. It wasn't too much of a surprise that we rejected there, especially with how fast we ran in that direction. The faster the move, the less sustainability it has. It creates like a liquidity vacuum, and there's not a lot of structure underneath it, so that when it takes a rejection and pulls back, there's nothing there to catch it. So that was a first shot. You could consider maybe we got a little ahead of our skis and took the smackdown, but we did close on the day higher than the previous day, and that is the whole deal, right? Just like how every day on the way down, we would get those pre-market moves where we fell really deep, and then we'd rally back up to where we closed lower than the previous day's close, but it wasn't some drastic extreme fall. It was just nice, clean, orderly all the way down. You very likely are going to see the same kind of moves all the way back up, where we get those really big moves in the pre-market and then it sells a lot of it off. and yet we still close higher than the previous day, right? Now, yesterday, the low was higher than the previous day's low, but the close wasn't higher than the previous day's close. So that's why we got that red bar there. So a lower close, but we did get the higher high, we did get the higher low. If we're using OCR analysis, that's exactly what we would be focused on. And yesterday would just be a warning. Higher high, higher low, but lower close, right? That becomes an important part of the narrative that we have to throw in there. So now we do have a range worth focusing on. It is the 50% of the week. We could mark that out at a 25%, or we could just consider which candle is in control and focus on that. The candle that's in control is from 817. So that gives us these levels here with 4407 and a tick as the 50% line in the sand. It's the level that we really want to focus on. So step by step, level by level, so far we have a trend change if we're using OCR, right? But we do have that blue line. We got to get through it. We got to get above it, and we got to close up there and then focus on the 20 and the 50. Looking at the volume from the overnight, we're sitting relatively normal around 98. So nothing to see here. Basically just get that out of the way at this point. I like to show this screen so that when you go back, say you find a day that you want to study in detail, and it happens to be, oh, I don't know, 4 months ago. So you're looking through the intraday chart, trying to figure out what happened throughout the trading day, and you're trying to study a trade setup. You need to know what was the economic events that were going on that day. My morning briefings have all of those data points, right? So if you have an intraday day that you want to look at, go back to the morning briefing from that day and see what economic events were happening so that you can understand the price action that you're looking at. And these morning briefings go back for a couple of years. There's not a lot of charting platforms that will let you look at a 5-minute or a 1 minute or 15-minute from a couple of years ago, but it is doable. But you would still want to know what was on the table that day. I didn't mention it earlier, but we do have the petroleum status report at 10:30 today. So if you want to focus on USO for an opportunity to trade at 10:30, that's not a bad way to go either, right? You sometimes catch a pretty good scalp. 10-day, 30-minute volume profile. I guess we could say it's a classic B, but it's pretty nasty. We are focusing on getting through this shallow area, which should not have had the power to reject us if we're just looking at the volume. And yet we already discussed all of those different things of resistance that were sitting there. So it's not a surprise that we rejected, even though there wasn't a lot of volume in that area. Point of control is still a long ways off, and the top of this profile should not come down to us until next week. All right, so either we go up to it or we just have to keep going sideways until it begins to lower the top of this profile. By next Wednesday, we will be at the top, even if we don't break above that weekly expected move, right? Because we'll continue to lose this volume across these highs. And by next Wednesday, where my orange and red lines are down here at 44.40, that'll be the new top of the profile, at which point we will have a very narrow profile. Long way to go until then. All right, so I kept that VPOC yesterday because I wanted to see if we were going to interact with it later in the day, which we did, but we basically one touched and then just ripped through it and never came back to it. So we're done with it now. Take that off. And we have one from yesterday, which I really thought we were going to hit it this morning, and we ended up turning around and going back. So we'll just clean this up here a little bit. It's yesterday's point of control, 43.9875, and so far it's untouched. So if we come down into that level, we're going to anticipate at least a first touch play, and then anticipate a reaction out of the market on that. If we get through that, we got 43.87 to the downside as well. All right, we're back below the 10-week. It's not a surprise. And we can see the levels that we've been focused on through most of the week. Just kind of clean some of these levels up. Here is the weekly expected move, 44.39. Tagged that yesterday, really nice clean touch, and back down we went. So we're holding within the weekly expected move as we would anticipate, right? That we're going to close for the week inside this level. The warning candle from yesterday with the lower close implies that today could be a sideways day. We really got to, we need a catalyst. And while there's a couple of different things on the table that could provide that catalyst, it's hard to see how it's going to be enough to get us out of this zone, because that's what we're working on getting out of. This controlled candle from 8 to 17, we got to get out of that. And it's a long ways off on each side. So across the top, all of that resistance is still there. And there's just going to be a lot of work either direction. I'm still of the opinion that we're turning around now. We're going to start working our way back up, but it won't be a straight shot. The wall of worry is tall, and there are a lot of bricks in there, a lot of things in that wall. And it spans the globe, right? We've got things going on over in China. We still have to be really concerned with Japan. We got Europe and all of their economic issues. So there's a whole lot on deck. And one thing that continues to pop up more and more now is in the fall, this big showdown over spending. You take the downgrade that we got in credit, you continue to focus on all of the debt ceiling and that huge fight. We're not even close to being done with that mess. So yeah, like I said, the wall of worry is tall. The move to the upside won't be in a straight shot. And you get things like what happened with the dollar here in the overnight, right? See, that move is fast, drastic, and extreme. Now, this is a liquidity vacuum. So at some point, we're going to expect to come back down to that 103.40, but it's not owed today, right? So we can say at some point, sure, but it's not destined to go back down there this morning. Bonds are continuing to hold off of that reversal from the lows. So far, so good, but we've seen this before. So, one day and a follow through isn't very much. It's going to have to do more than that to convince us that it's even trying to stabilize. Until it gets at least above 121, then this is still a threat to continue to go lower. And take a look at the 10-year. We are continuing that move to the downside, completely opposite of what's going on in the dollar. I mean, it has to resonate loudly, right? That there's something going on out there that is fundamentally different than everything that we've been dealing with from the first part of the year. And until this transition is done, a lot of things are going to be at risk. And any new swing trades or any new opportunities that you try to engage in are going to have an elevated risk because we are in a sea change, right? We're in a systemic shift within the market environment, and it's not done shifting yet. That changes the narrative, or it takes away the narrative we had without giving us a new one yet. So until we get that new one, we're kind of just chopping about, and you can really see that if you consider what's missing out of the day-to-day price action, and that is the narrative. US dollar Japan continues to hold underneath that 146.50. So far, so good. It's helping out. I mean, on the week, we've not yet broken out to the upside higher than last week's high. So, at least we have that. Of course, we haven't broken out to the downside either, but just maintaining in that range, getting that lower high, and now holding underneath that lower high is a really great start. We need this thing to calm down so that they don't have to run intervention. We don't see it hitting against the 10-year. We don't see the effects of that into the S&P. So if everything can just, calm down a little bit, should be a lot better off. What you want to watch through the day today is that dollar. We don't want to see another big move like that. Kind of consider how the S&P moved when the dollar moved like that. Here's that big drop to the downside. Here's that big spike to the upside. Now, chicken and the egg, which came first, or which caused which? The dollar moved first, and then the S&P felt that. So this isn't a teeter-totter system. One goes up, the other goes down. That's not what this is. But consider it a weight against the market, right? There's always that old analogy of the guy running up the mountain when you get into trading mechanics stuff, right? The guy runs up the mountain and he stops and he catches his breath, and then he runs up the mountain, then he stops and catches his breath and runs up the mountain. It's an old analogy. It's been around forever. Take that same person and now add a 100-pound rucksack and have him still make the run. So he could do it. It's just going to be more of a struggle. The dollar moving up like this is extra weight, extra pressure, more negative effects against the market. So the dollar going up isn't making the S&P go down. It's just making it harder for the S&P to go up. Okay, so that's a really good way to look at it. The fact that the 10-year is going down is great. That should be helping us, and we're not seeing any love out of that at all. So that's where the disconnect is at. Continue to watch that dollar. And I don't want to say to ignore the 10-year, but you do want to watch for the 10-year to sync back up with the dollar. If they resynchronize and begin moving in concert to the upside, that's really going to put some weight on the market, right? That's going to be a negative impact that I believe would reverberate much stronger. For the ZB, you can use it a little bit like a bellwether. As long as this continues to maintain the range to keep its advancement without breaking into new lows and giving us signals of weakness, then everything should be okay. Kind of just, a collective sigh of relief. This thing starts breaking down again, then you want to circle back to the 10-year and the dollar and see the effects, because this is one of the biggest threats right now, is that we're going to see continued sell-off in bonds. It's a mess. And when I first got into looking at correlated market structures like that, I was concerned that I wasn't able to always understand what I was looking at. And the fact is that there's a lot of times what you're getting isn't a signal at all. There's just nothing there to see, right? The only thing you can do is acknowledge what's happening and that it doesn't fit with what has been happening, and to stand aside or not to use it for any kind of signal. And that's not just with these correlated markets. That's with everything else. Price action indicators, the market isn't giving you a trade signal or even a signal of analysis 24 hours a day. A lot of times it's just random walk or noise or an effect based on time and flows. As long as you recognize it, you're able to manage your expectations. All right, the EV markets are down the most. So we can see Tesla's getting hit pretty hard. Lee, really not so much. XPEV as well, holding at yesterday's low without really breaking down too much yet. Ford and GM kind of look pretty good. And Nikola's not getting whacked at all, but it already had been whacked over the last few days. Tesla's the big one. So this morning we're down to 226 when we closed at 233. The line in the sand that we had drawn, let's just go out to the weekly so we can keep things consistent. That's really the level that we want to focus on. And you can see where Tesla's at this morning, 226. It's right at that 50% level. You got to love it when things just confirm what you're working on, right? So when we were on the weekly and we had this really big gap up and that strong run to the upside, all of that looked really good. And then we hit the 10-week moving average. And we took that rejection in Tesla yesterday, and it was building this really beautiful bear pennant. And that's just about a textbook pennant if we were to, look at how it was presenting yesterday. That's a very beautiful bear pennant. Then we broke to the upside this morning, kind of negated the whole thing, and now it's headed to the downside. If we look at yesterday, though, as maybe a rising wedge, it's not exactly a rising wedge, but rising wedges break to the downside, and they'll often get this little fake out first. Right? They'll often do that first. Either way, we are on the 50% mark. On the week, it's how we close, which is going to become really important, right? So we have the 50-week, which is basically what we opened near on Monday, and it's underneath this. So if we continue to fade, 222.67 is going to be the support on the week that we want to focus on. We don't use moving averages for support, right? But it's still the area where we're going to anticipate institutional actions, right? Because they'll use it as a line in the sand too. Healthy, unhealthy, good, bad. It sounds simplistic, and yet, they're people too. They tend to do the easiest and the laziest. So watch for 226.50 to hold. If it doesn't, we will use the 50 EMA weekly as gravity and as a target. That's what we'll focus on for the short side move. Unless you're trading shares short in the pre-market, you haven't really had a chance to participate in this yet anyways. So you're going to have to wait for the open to even get in. One of the things you might be looking for near the open or at the open when we have an opportunity to trade the options is for a small bounce back up, maybe reject across yesterday's low, and then continue that move to the downside. If we do get above that level, then look for, say, the 15-minute line in the sand, right? The 15-minute open range bar. What we're looking for is a pullback before going lower. If we consider this like a liquidity gap, the market's going to want to try to fill that before making its move to the downside. It's going to want to, it doesn't mean it's going to. So we can use yesterday's low. We can use yesterday's 4 o'clock close, and we can use yesterday's 15-minute bar or 5-minute bar. Either one, it wouldn't really matter either way. And all of those are going to be rejection points for this to roll over and continue to make its move to the downside, with 222 as the target for that downward move. It wouldn't hurt asking why it's down, by the way. So if you're interested in trading this to the downside and it's obviously leading all of the EVs lower, hit the news and find out why it's going down so much? Well, they're coming out with all kinds of stuff trying to save it. Crash reports. All right, so that's the one that's down the most. For the rest of these, it's either positive or flat. Those China ADRs are positive, not by much, and you can see that they also gapped up like Tesla did, and now they're giving it back. So if we were to go in and kind of pick and choose, say BABA, gap up, it's giving it back. I think we're going to see a lot of that, right? Because NVIDIA, and then the news that was coming out. So either one of those and a lot more on deck. The main thing at the moment is going to be, since all of the market is giving this signal, we want to see if all of the market is going to stabilize and continue this move up, or if it's going to begin to break down. It'll look the same way, whether you're looking at the NASDAQ, the S&P, Dow, the Russell, Tesla, NVIDIA. It's not, well, maybe not NVIDIA because of earnings, but it's not really going to matter what you focus on. It's pretty much all going to have the same pattern, right? The ones that won't look like this are the ones that are completely standalone anyways, that aren't being traded by the algos in the same basket. So the nice thing about that is the correlation effect. If you start to see the turn in AMD, you're going to be able to see the turn in the NASDAQ, or, pick the thing with the best liquidity, because, if you're trading AMD, you're trading QQQ, whether you like it or not. That's really what you're trading. So why not just trade the Qs? They have a much better option structure. Now, AMD might have a greater dollar for dollar move. AMD might have, a higher rate of change in its options structure. But when it comes to liquidity, the Qs are like 2 steps behind SPY, and SPY is the best thing you can ever trade for liquidity. So that's the turn we're looking for. It's not going to be subtle. There it goes. It just seems to get stuck lately. So we can see the K-Web, the emerging markets, Bitcoin, they're all still up, but they are all giving it back. The FANGs are already back to flat. All these others are already to flat, and they're going to start to turn negative here soon. Things that are down: energy, semiconductors, and nat gas. All right, so that short in USO really just isn't going anywhere. Whether you're trading crude or using USO, either way, it's still the short isn't following through. We're just kind of chopping about here, really not going anywhere. And yet there's no reason to go long. I've had a lot of people asking me, is this the time? Are we finally breaking through this thing? Not yet. But look, Grimes talks about in his book let's see, which book was that? The Art and Science of Technical Analysis. It's a free book. You should be able to find it. He talks about this pre-consolidation, right? Where the market will sit down here and kind of chop right underneath a significant level, building up a lot of energy. Well, he doesn't use the word energy, but building up structure down here and then get that big breakout. So if we look at it from that point of view, then sure, crude fits that narrative, but you don't have any signal of that yet. So if you take the long, then you're just, it's the cheapest long you could get in relation to risk, but you really don't have any reason to go long here yet. So the base case argument would be at least use 50% of the previous week for your line in the sand. If we can get above that, then you could at least have a valid reason to attempt to go long. $81 in crude. $72.76 for USO. If we can get above that, at least you got the argument that it's trying to turn around. Otherwise, we trade what we have, and what we have suggests that we're going to go back down again. You know, even if we get rid of all of this and just use the R line regression, start at the left, just drag it across, that is continuing to trend to the downside. And these are just waves back and forth. Reciprocation suggests if you get a 2% move on the top side, you'll get a 2% move to the downside. And after this really big move in one direction, which happened to be nearly 15%, I guess it magnetized my move, 12.7, you get the same anticipated move for the other side, which puts you at right around $58. Imagine how it lines up just like that, right? Just like it's supposed to. Because that's just the way things work. So the short's still valid. It's just having a hard time getting going. And if you're looking for an entry into that short, a break below $72 would be a good way to go, or getting outside of last week's level. So 71.29. Break below that, you got a pretty valid short. Just be careful because that blue line there, that cyan line, is the 10. That's the 10-week, and the orange one is the 50-week. We got a lot going on other than energy, though. So out of the FANG names, NVIDIA's weight is going to be a negative pressure that all of these others are going to have to struggle with. Apple's holding up pretty good. At least it turned back so far. And the line in the sand at the moment is going to be yesterday's high, not just Apple, but really across the board. We got to get back above yesterday's high and keep it. But for a lot of these, since they've already faded to the downside, where we closed yesterday is going to be a good starting point. Rather a rebound from that, getting back above that, and then focusing on getting through all of this Globex trash. And I just want to add this one warning. If you're looking for an opportunity to go long today, remember it doesn't owe you an up move. We can go sideways today and it would still be considered healthy as long as we can close equal or higher than yesterday's close. So this market doesn't owe us a big move today. If we move up through the day today, watch really close to that Globex high. SPY, the Qs, AMD, whatever it is that you're trading, that Globex high, watch that because we moved away from it really fast. Consider that unfinished business or trapped traders. And anybody who's still bag holding, when we get back up into that level, they may be very happy to get the heck out without having had to take a loss, right? So just be careful. It's very likely we're going to get at least one first touch play when we get up there, and it might just be the selling point to go right back down again. If we get through that level and happen to close above it, then it's game on. We'll focus on yesterday, we'll focus on getting that breakout, and then focus on last week's high, getting that breakout. Step by step, level by level, nothing to it. Everything's got the same pattern today. So really just pick your poison, stay away from the ones that are getting whacked the most. Today's not a day to play the contrarian, right? You know, like some of these days we look for things that aren't up very much for a move to the upside, or we look for things that aren't down too much to make a move to the downside. Today's not that day. If you're trying to trade long, trade the things that are most long already. If you're trying to trade short, trade the things that are most short already. That's the kind of day it is today. Watch the news. Everybody be careful, be safe, have a good day. I'll see you all tomorrow.